So what do you do if you have a seller who's willing to do a price reduction or give you a credit to help you purchase their home? Hey, I'm Joshua here with another edition of Mortgage Clarity. And, we find ourselves, this is December of 2022, which is why I'm rocking the old Snoopy Christmas tie here. And we find ourselves in a market now where after years of sellers not being willing to negotiate at all on price or seller credit or nothing, sellers are now willing to negotiate. So that's one reason why I think now is actually a really good time to be buying, because once the market changes again, it might be back to where you just have to take what the seller is willing to give. So what do we do if we have a seller that says, you know what, I'm willing to give a 3% price reduction on my home, or I'll give you 3% to use how you like. And if they say how you like, how do you know what you like? So that's what we're going to dig into this video. Now, this video is going to be a little bit technical, a little bit long, but bear with me. A lot of good points, things that are going to help you make a good informed decision. These are things you should be talking to your lender. Your lender, if you're working with a good lender, should be able to help you explain these things and help them actually relate to you specifically. So right now, this is going to be a generic video to look at here. But I also, if I jump into it, just want to reiterate, this is not a rate quote. We're going to look at some rates and some payments. But this is not a promise to land. We're not qualifying you. Rates change all the time. It varies based on property type, location, occupancy, is it 1 unit, 2 unit, all kinds of things. So again, this is for comparison's sake and not a quote on what actual rates are. So let's go ahead and jump into this. So here's the scenario we're going to look at today. We're going to look at the assumption that we have a $500,000 price point, and that's list price. We're going to do 5% down, so that's we get a loan amount of $475 based on 5% down on $500,000. And we're going to say rate today at par, meaning you're not paying any additional discount fees to buy down the rate. You're not receiving any credits from the lender for taking a higher rate. We're going to go with the par rate. Say that's about 7% today. We'll also say based on the borrower and what their debt ratios are on stuff, mortgage insurance costs, because they're not putting 20% down, it's $210,000. I wanted to do this with a low down payment because I think most borrowers out there can't put 20% down. So I want to make this video as applicable to as many people as possible. But if you did have 20% down, you would not have mortgage insurance. All right, so here's your total monthly payment, principal, estimated taxes, estimated homeowners insurance, the interest, as well as your total cash flow is $36,500. Okay, so that's the starting point. Now the seller is willing to negotiate. What do we do? So the first one is a price break. Well, if we take the $15,000, just take it right off the price point, we now have a slightly lower loan amount of $460,750. Now, what that means is my down payment changes a little bit. Not much of a benefit to you as the buyer because your down payment didn't change all that much. And look down here, your payment didn't really change that much. This is why, for the most part, I think sellers, if you happen to be watching this video, just doing a price reduction probably isn't the best thing for you. You'll get a little bit of news, top of the list because you just did a price reduction. A few people look at it, but from opening up the net you're spreading, you're not really bringing in more buyers who couldn't afford the cash to close or more buyers who couldn't afford the monthly payment because it didn't do a whole lot of benefit to the buyer actually. So, but here's an option. Here are 3 other really good options that we want to look at. Let's talk about a permanent one. The permanent, compared to the 2-1 buy down, means we're going to take that 3% or $15,000 credit in this scenario, and we're going to buy down the interest rate. So let's just say that you're able to buy down that rate to 5.75% using those full 3 points, and that's the 3% right here, and you buy it all the way down. Mortgage insurance changes a little bit here because, again, you're back up to the same list price, so your mortgage insurance is about $210,000. You see your payments at $35.45. Cash to close stays about the same as you would on the other scenarios. Not much difference there on the price point there. Now, on the temporary buy down, the difference here, and this is really important to know more about this, check out my video on the 2-1 buy downs. I'm not a huge fan of these in most cases. They're not bad. It's just for most borrowers, it probably doesn't benefit them because the key thing with the buy down is that you're only temporarily buying down the interest rate. So you're getting a 2% lower start rate on the first year. So 5% rate payment based on a 5% rate the first year. The second year, your payment's based on a 6% rate. But then from year 30 on, your payment's based on 7. And therefore, the lender must still qualify you on this higher payment. Whereas with the permanent buy down, because it's permanent, it's 30 years, the lender qualifies you here. So this permanent buy down using the same amount of money as a 2-1 buy down will actually help more borrowers qualify for the purchase of the home than simply doing a temporary buy down. And so for that reason, I think most borrowers probably wouldn't actually benefit as much from this as they would from here. So, but here's the temporary buy down does give you that first year lower payment. And we're going to look at some things here below, so bear with me. And changes the total cash to close a little bit here as the way the numbers work out as well. Now, the seller paid closing costs. This one here in this scenario, we're not actually using the full $15,000. There's about $3,000 left on the table, estimating what closing costs might be for a home like this in Benton County in Oregon. So in reality, you would probably want to do a hybrid in this scenario where you might want to take that 3%, the unused, the $3,000 you're not using, and either do a slight price reduction, or more likely use the $3,000, buy down the interest rate to increase the closing cost a little bit here. You might land somewhere like around 6.5% and you get a full benefit. But for just a straight comparison, we're just going to leave it alone and just say, okay, that's unused seller credit. But you can probably find something that would make this fall in somewhere in between these two. All right, so now here we are. We're spending the $15,000 on the price reduction, the permanent buy down, the temporary buy down are only $11,500 on the seller paid closing costs and take maybe a little bit lower than the price point. So which is the best option for payment over time? The 2-1 buy down is the lowest monthly payment out of pocket cost. So when you look at what you're paying on down payment and closing costs and your monthly payment, up to just a little bit lower than 2.5 years, the 2-1 buy down will be the least amount of money out of pocket. Now the reason it's more, it still saves you past year 2, even though now your payment goes higher at year 2 in a month, your payment's actually higher than the permanent, is you did get a savings the first 2 years that carries forward. So at this point, you've kind of absorbed all that savings, and now this is where the permanent buy down actually starts to cost you less out of pocket. So from strictly looking at a payment standpoint, if you think you're going to sell or refinance in less than 2.5 years, the 2-1 buy down will be the lower out of pocket or best cash flow for the house. Okay, and as you get down here, you would be able to see the difference. This is what I do for my clients, and we'll actually look at all these dots and see how they're on top of each other. This just helps us see how close. Because again, splitting hairs here, technically this is the better one, but by how much? Well, we can go to year 3 and do the math, and there you go. Okay, so let's just do a summary. These are just some key takeaways as far as the benefit of each of these options compared to no price reduction and no credit. Obviously, the benefit's $15,000 seller credit that you're using on this one, $11,500. Here you don't have as much closing costs because the seller paid them all. So there's zero closing costs. You just come in up to 5% down. Over here, you do have a little bit of a reduction in the closing costs based on how the prepayment interest calculates out on these here. So all the green is good. The only red you see here is if you simply do the price break, you actually have a little bit of a negative here compared to the, again, list price, because you're actually not reducing the principal balance quite as fast with that smaller amount. Now at year 4, $645 divided by 4 years, it ain't that much. But technically, I like to deal with technically, there's actually a bit of not as much of a benefit here from the principal reduction through payments over 4 years. Okay, so this last little section we're going to dig into here is just going to help you look at cost. Let's just say you're a client, you can afford the payment, you've got the cash to close, you just simply want the best deal for you. You want to pay the least amount of money on owning this home over time. What's the best way to do that? Again, some borrowers, even though they might want that lowest cost over time, for them it's, I just don't have the cash to cover my closing costs. I need the seller credit. For other ones, it's, hey, I need that permanent rate buy down because I want to buy that home, but I just can't afford it. My lender won't qualify me at that price point. So the permanent buy down helps me do that. And then there's the 2-1 buy down again. If that client says, hey, I can't afford that higher payment. My lender says I'm approved for it. I don't really need the money for cash to close. But for personal reasons, investment opportunities, who knows, for whatever reason, I just need more cash for that first 2 years. And after 2 years, I'm going to feel more comfortable with a higher payment. So that's the 2-1 buy down. But for those who just simply want the best cost, here you go. If you plan to sell or refinance or pay off your mortgage in less than 6 months, go with the temporary buy down. That's going to cost you the total when you take, again, interest, closing costs, all that stuff into account. That's your lowest deal. For a very small amount of time between basically 6 months to about 2.5 years, less than 2.5 years, so say an 18-month window here, if you plan again to sell, refinance, pay off the loan, a price break would actually cost you less in that time frame. But from that point on, going beyond that, the permanent buy down would be the better option. So, which of these options are best for you? Again, gotta talk to your lender. Depends on your situation, what your pain point is. So I hope this video was helpful. With this here now, with your agent, you can kind of negotiate maybe a little bit better. But again, talk to your lender, have them dig into your specific scenario. What are the actual costs for a 2-1 buy down for your program and your scenario compared to doing a permanent buy down or a cash close? Find out what's best for you and then make the best deal for you. So if you like this, hit the subscribe button. Also hit the thumbs up. Love your comments. Drop comments in there. As I see those, I will respond to you. Again, thank you so much. And again, this is coming to you December 2022. So have a very Merry Christmas. All right, bye for now.